is August of 2017. Time for another edition of the Zacks Ultimate Strategy Session. Just one of your benefits as a Zacks Ultimate member. And this month we'll see if John Blank and Sheraz Mian can agree to disagree on whether there's a Trump trade or no such thing. Steve Reitmeister answers more of your questions from Righty's mailbag. John Blank and Eric Dutram will conduct the portfolio makeover. There's top stock picks and more. But first, John and Dave Bartosiak lead off with their fundamental and technical views on the market.
Hi, I'm John Blank. I'm Chief Equity Strategist at Zacks Investment Research, and I'm going to do the fundamental market overview for this August time period. We've just gotten through a second quarter earnings season. That's going to be my first interest, is the second quarter earnings season. What I'm going to tell you is we've had record earnings, and that's a good story. And we have a good outlook from that record earnings going forward. Second thing I'm going to get through is the Purchasing Manager Index. It's called the PMIs for short. That's a forward-looking indicator because purchasing managers are going to buy something for the future. And we learned that the global Purchasing Manager Indexes are very strong, particularly in financials and technology. And those are the areas you want to focus on as an investor. So again, strong earnings season, very strong global PMIs. That's going to be my main story for you today. Okay, so we've got a new all-time high in quarterly earnings in the second quarter. That's the orange thing. 290.7 is my number that I'm looking at. That's the second quarter. And as you can see, it's much stronger than the first quarter, which is always weak, generally because of the winter. But we're bouncing back also from record highs, meaning last third and fourth quarter of 2016 were lower than this. And we're looking at 10% earnings growth going forward. That's a strong number. And you can see that a lot of that's also coming from many more surprises. That's 59.8% surprises versus 44% on average. A lot more beats on earnings and revenues. And that's what I'm going to tell you is all 10 sectors have been doing much better with growth rates this time around. The bottom point I want to make on this slide is valuations are still very high. This market's pricing in all this strong earnings, but you know that is what it is, and it's still going up. We can go a lot further up from here, trust me. But the bottom line is it's been a very strong quarter, 9% earnings growth, 6.5% revenue growth, and we look strong going into the third quarter. Again, my PMI numbers, and I want to get through this, is the global sector PMIs. Global sector PMIs are very different than US PMIs. And the point I want to make here on this slide is technology is the fastest growing, but financials has 3 of the top 4. That's the great news. The bottom point I'm making here is the fourth one running, all the sectors are doing well. That's the strength here that we like. All the detail is coming through in all of the sectors. That's the kind of rebound you like as a stock investor. A lot of ways to win this game. All right, I'm going to finish up with the global composite manufacturing and services. So this is all the manufacturing and services combined. Is a little different measure. But what you're pointing out is, on this slide, is new orders and input prices are the strongest. What I want to tell you about PMIs is when they're 55, you've really got some GDP growth. 50 and 52, not so much. So new orders is expanding and input prices are stronger. That means you should be playing industrials and playing materials. That's what I like. That's what I like best. So that's what I have for my fundamental view. Record earnings, strong PMIs, focus on materials, focus on banks, focus on tech. That's what you got.
Hello, everybody, and welcome to the technical portion of our show. I'm Dave Bartosiak, editor of The Momentum Trader and Home Run Investor, and I'm going to look at some key technical levels on the S&P 500, on the NASDAQ Composite, and let you know which sector was actually the best performing sector over the course of the last month. You can go ahead and place your guesses. I'll let you know at the end. So first, why don't we go ahead and get started with the S&P 500. Taking a look at the S&P, I'm just going to go a little bit more recent here. Basically since mid-March, and it's been relatively choppy, and of course you didn't need me to tell you that. I'm sure that you've seen it. But what I've done is I've used the May low through the June high and drawn some retracement levels here. Now the reason I did that initially was I was looking for support in late June and early July of where the market might come down and find a bid. What ended up happening is kind of lined up with the 50-day moving average. So that provided the market plenty of strength. And if you note here, in May, we kind of dipped one day close underneath the 50-day moving average, but then rallied up above. And then there's a period in April where that was some pressure too. But basically, the 50-day has done a pretty good job of scooting this market along. Now that we're on the outside of these levels here, we can use extensions. So rather than going 38.2% in the negative direction here, we can push that into the positive direction to get areas of potential resistance. And that's what I've done here on the S&P 500. So using that, you have 2492 as the next target here. Granted, that's so close to 2500. That's going to be a key psychological level. I think that's where you're going to see the S&P 500 extend. So keep your eye on 2454, this high from June, to be the bottom end of the range, and then 2492 or basically 2500 to the upside. Now, what's been more complicated here and people have been paying a lot of attention to is the NASDAQ composite. So I did the same thing here with the NASDAQ, and the NASDAQ has gone so long, so strong, and then suddenly started to falter. So even in May, when the S&P 500 came down below the 50-day, the NASDAQ still resisted. It did come down there in April for a little bit, and then again, here I had these retracements that kind of ran out of gas. They spent a few days underneath this 50-day moving average here on the NASDAQ, but collected a bid and have gone higher. Here's the thing with the NASDAQ though. The extension that I drew on the S&P at the 38.2, on the NASDAQ at 64.69, and we nearly touched it at the end of July on that big down day. So I don't want to call this Tech Wreck 2.0, but there's these days that we end up having where it's, these just huge down days where the selling starts and then barely relents but until the very end of the day, and then all of a sudden there's a rally that gives some back. So it's interesting that we've had two of these days just over the course of the last couple of months here. So areas to keep an eye on, obviously this previous high, this 64.69 level, and the highs prior to the tech wreck, and that's providing a little bit of a shelf here, but it's making me a bit nervous because you're getting these wicks that have dipped down below those levels. So I think that the 50-day down at 64.57 is begging to be tested, and that's likely the next place. Okay, now the answer to our question that I'm sure everybody was wondering, which sector has actually outperformed or performed the best over the course of the last month, and that has in fact been basic materials. So here I've pulled up the IYM chart. Basic materials are up 4.5% over the course of the last month. Now a lot of that happened early on in the month, and since then they've kind of tailed off. But I just wanted to show you here that this sector has been the hottest, and the IYM specifically has been finding a bid at the 50-day moving average. So if it comes down to there, that might be a good place to start shopping for some of those good old-fashioned basic material stocks. Okay, so that's all I got for you here today on the technical view for the Zacks Ultimate Strategy session. Have a good day.
Still ahead, John Blank and Sheraz Mian will try to agree to disagree. But first, here's a list of recent Zacks Ultimate top movers.
Hi, I'm John Blank, Chief Equity Strategist of Zacks. I'm with Sheraz Mian, who's the Director of Research here at Zacks, and we are talking about, is there a Trump trade now? Now, this is August 2017. I'm not talking about the Trump trade in January when we're all excited about this president. We have 6 months in the game with this guy. We have 6 months watching his administration. We have 6 months with his policies. Second thing I want to point out is I have a PhD in MIT economics program. I was TA'd with Stanley Fischer, who is the vice chairman of the Federal Reserve right now. So I am speaking from a position of strength on the economy, on this U.S. economy, and on this U.S. government. Having said that, I'm going to take the negative, the bear case on this administration and believe that the chaos at the heart of this administration is going to overwhelm many positives. I don't necessarily think that's going to take the stock market down or the economy down, but I do think it's going to basically not give the positives from a Trump trade perspective. Sheraz is going to take the point of view that, in fact, there is even with 6 months in the game, a real story here. So with Sheraz, with that, I'm going to let you take over and prove to me that there really is a Trump trade.
Yes, and I have a slide here, John, that I want to share with you. And what I have in the slide is basically the stock market performance for the 16 Zacks sectors in 3 distinct periods. The first column, the pre-election 16, is basically showing the performance from January 1st through November 7th, 2016. The second column, post-election, that's November 8th through Friday's close. So this is the post-election. And then this year is year-to-date performance. And you could see here that we have a number of sectors. For example, if you start from the top, look at the fourth from the top, medical. Down 13% through November 7th, up 11.8% since then. Look at finance. Finance was left practically for dead. It was up only 1% through November 7th, up 20.5% since then. Aerospace defense, relatively smaller sector compared to healthcare or finance, but still aerospace was up 3.7%. It's up 31.7% since then. Now, what's the takeaway from this? The takeaway is that the dysfunction, the chaos that you argue about on the policy side from the administration is real. But for this momentum from these sectors, and there is a number of others whose gains post-election could only be ascribed to what this administration has either done or is expected to do. So you don't need detailed reforms and policy legislations coming out of Congress for this momentum to continue. As long as you have this friendlier administration that on the margin, whatever administrative and statutory changes will be made favorable to these guys, then that should be enough for this momentum to continue. Just a brief example, look at finance. We will not get the Dodd-Frank repeal, but we know that the Fed regulatory function, it will over time change because the president appoints those Fed governors, and it is these Fed officials that will reinterpret what the Dodd-Frank legislation means, so what Volcker rule means, and what the capital requirements are, and all of that. So the stress test that the banks went through in the Obama era and the stress tests that banks will go through in 2018, for example, will be under the same law, but they will be interpreted differently. And I think that's enough for these industries and for these companies to continue the momentum. And that's the basic rationale why I say the Trump trade is still in place.
Okay, well, let me put in 4 pieces of this administration now that I see it. Number 1, this administration has a chaotic and amateurist president. What that has meant is a Secretary of Defense who's a Marine, James Mattis, a Marine, John Kelly, at the Chief of Staff, and I'm not sure of his designation, but a Marine or an Army guy, general, running this National Security Council. 3 generals around a chaotic president. Number 1, it shows you how chaotic it really is. Number 2, you have the Senate. The United States is a nation of states, and the Senate is in fact running the country in the response to that chaos. Number 3, you have the hope for Goldman Sachs team, which is Treasury. You have effectively the national director of Gary Cohn, and then to some degree Wilbur Ross, who's kind of woven in even though he's not a Goldman Sachs guy. Number 4, you have the House of Representatives, which has been so chaotic on their own right that we don't even know what they're going to do. So I think that this is the problem, is that the administration has become ironically bipartisan, the Senate keeping it together, but if we didn't have the Senate, this whole administration would collapse on itself. And by the way, I haven't even brought in the whole FBI Director Mueller thing. That can blow up on us at any point in time. That's enough chaos for me, and that's what I think is a big, big problem. And so I don't think when markets don't like uncertainty, when we start getting uncertainty on the table, when we start getting the grand jury reporting in, when we start seeing the dysfunction leading to real policy paralysis outside the country and national security, we're in trouble.
Yeah, I think that's a fair point. As long as we don't get to that stage, as long as we have a functioning administration, but the fact that no new legislation will come out of Congress, the hope for reforms will not take place. I think that's not enough by itself to kill the rally. But the legal issues, if they do reach a boiling point, will be a problem for all of us.
Yeah, so I'm on board with this idea, Sheraz, that you have, which you've shown with us, which is that aerospace and finance, particularly the defense companies and the banks, because of my Goldman Sachs story, because of my military story, I'm on board actually with that part of your Trump trade. I'm just not convinced that the other elements of this administration's dysfunction are going to overwhelm it at some point in time or cast just a lot of negatives on top of this market. So I'm going to finish up today and just say, I hope you enjoyed our segment on this idea that there is a Trump trade, a relevant Trump trade, and I think Sheraz did a great job pointing out that the stock market certainly believes it. Now we just have to see the fundamentals show up. And one way or the other, I think Sheraz made a great point, which is it's business friendly one way or the other, and that's the thing the market likes. I hope you take away my point, which is, by the way, chaos is chaos, and all the responses that I mentioned, all four, are a response to chaos.
Before we get to Righty's mailbag, here's a list of recent Zacks Ultimate new additions.
Hey everybody, welcome to Righty's Mailbag for August 2017. Got three more good ones today, so let's dive right in. Coming up first, we hear from one of our customers. I am wondering what are your thoughts about investments during unstable times like nowadays? There are worldwide tensions in North Korea, Middle East, Russia, Iran, etc. So get emails like this all the time. There's always something to worry about, but let's be honest with ourselves. When has there not been problems in the Middle East? When has North Korea not been rattling their sabers? When has there not been issues around the globe? And hey, since 9/11, there have been two bull markets going on. So what I'm saying is we have to separate out the headlines and these tensions around the globe, which make for good news and getting people to watch the news like there's some great concern, but it's separate from the economy, it's separate from earnings, it's separate from valuation, which are the three things that really drive the stock market. So we have to separate those things and focus on what truly is driving stock prices. So here again, like I was saying, since 9/11, there have been two bull markets with ample gains made by folks. So let's do ourselves a favor. Let's be good world citizens, let's pay attention to those things, but separate that out from what is driving the stock market, which are the things that we're going to be concentrating on with all of our various services. And that continues to point bullish. Okay. Next we have from Keith A. How can one portfolio retain a position and another be selling the same issue? Okay. So what he's saying is, hey, Zacks has 18 different portfolios, and sometimes it seems that your editors are doing different things. Some are buying, some are holding, some are selling. Why is that? Actually, I think this is a good thing, but it can be confusing on the surface, so let's explain that. We've created 18 different portfolios because there's that many different ways in which to invest. Some people are fundamentally driven, some are technically or chart driven. Some people are long-term investors and some people are short-term traders. Some people like value, some people like growth, some people like momentum, some people like income, some people like an array of all those things. So when we think about that, or just stocks, options, ETFs, and all that kind of stuff, you can understand that there's slightly different missions going on for each of the portfolios and handling things in a different way. So let me give you a prime example of how this plays out. Let's say you have a long-term portfolio that owns a stock and a short-term trading portfolio that owns one. The short-term trading portfolio, he's trying to make timely gains, right? Oh, I see an opportunity, the stock flies up 10, 15% in just a few weeks. He's going to clip his profits and move it elsewhere. So that's a that's where someone is selling. But the long-term portfolio, he's holding on. He knows there might be a retraction in the stock price a little bit, but because the earnings momentum at play for that company, there likely will be another beat, another raise in the future, hopefully many of them, which continues to drive that stock forward. So he's going to hold on through any disruption and keep going forward. So that's how that our portfolios can do slightly different things, but it makes sense given the mission of those services. All right. Lastly, what we have here is from Keith L. Just out of Bloomberg, Alan Greenspan suggests the bubble is not in stocks. The bubble is in bonds. When the price adjustment comes, it will be fast. What do you think about that? And the thing is, I completely agree with Alan Greenspan on this one. And I think the best way in which to set the stage for that is to bring up a chart of the 10-year Treasury yields. This is going back 50 years. I think we can see clearly from this chart that there has been a peak and down, down, down. We are at historic lows. In fact, just back here, we're talking about 1.4% on the 10-year Treasuries. The reason why we're at historic lows is because of the Great Recession, because of the efforts the Fed went through, the quantitative easing, to push rates down so low to attract people to put their money in riskier places, in the stock market, in building businesses, meaning don't just store it in cash, don't put it in your mattress, let's put that money to work. That's what rebounded the economy, kept things going forward, and why we have an 8-year bull market. But from these historic lows, there's only one direction for it to go. Rates have to come higher, which will hurt bond prices, which will create losses in bonds. And it's really just a matter of when, whether it be that the economy finally starts producing inflation and things go higher, whether it's the Fed raising rates, something, this has to normalize over time. So that is why I recently got on board the bandwagon, added some TMV to my portfolio. That's shorting the bond market with a 3X. There's two others you can consider, TBT and TBF, that also do these things, but not in the 3X variety. So if you don't like the dynamite of the 3X, you can go for more of a firecracker with the others. But bond rates are going to go up in time, just a matter of when. So that's it for Righty's Mailbag, and look forward to doing this again next month.
John Blank and Eric Dutram will conduct their portfolio makeover right after these interesting insights from Zacks Ultimate Editors.
Hey everyone, Eric Dutram here. Welcome to another edition of Portfolio Makeover. I'm joined today by our Chief Equity Strategist, John Blank. John, thanks for joining us.
Eric, great to be here. Came in from California just to be with you.
Oh, great. Well, it's fantastic to have you, and we do have a great portfolio to look at today. And it's actually a pretty sizable portfolio, but let's take a look at some of the key points that we noted right off the bat for this portfolio. We saw that the portfolio has a really good job of avoiding 4s and 5s. And if we scroll through right on the screen here, we can see that the portfolio does have basically a ton of stocks, a couple dozen stocks in total. But as we can see right here, there's really no 4s and 5s. So we do like to see that. We do have this 1-4 TEGP. But beyond that, we see a nice series of 1s and 2s, and that's definitely something we look for when we're analyzing some of these portfolios. What are some of the other interesting aspects you saw when taking a look at this one?
Yeah, the thing I would point out to this portfolio management strategy is a couple things. The most important thing, I think, is the value. The Zacks value score has been totally ignored. There's D's and F's across this portfolio. I would say 70% of this portfolio is a Zacks value D or F. And there's a reason for that, because they are focused on quote-unquote hot stocks.
That's right.
Growth stocks. So the growth score is probably going to be good, and these 1s and 2s are probably good. The missing element is to understand that the story that you like has been bought, and bought big, and bought by everybody before you. So when a Z or F comes into play, you are playing a story stock, you're playing a momentum stock, and you're betting on this thing to carry on. Now, as we know, we are in a momentum situation for the market. This thing can work really well for this portfolio.
Sure.
Now, you tell me what's wrong with overvalued D and F stocks.
Well, if the trend doesn't continue, then we're going to be in big trouble with a big chunk of this portfolio. And as we can see, just what you're talking about here, basically the whole screen right now is full of Fs and Ds in terms of the value score. We do see some nice movement on the momentum side, including a couple upgrades. But yeah, really a ton of D and F and also a bunch of Cs. In fact, just 3 of 37 securities in the portfolio have an A for a value score. So it's a really momentum-focused portfolio. It might have some trouble if we do see a pullback because it's really tilted more towards this high-growth story stocks that we've seen working, granted, for the last couple of years, but you never know what's going to happen in the future.
It's probably also high beta, meaning you're probably outperforming the market. Now, the guys, I'm going to tell you 2 things you got to avoid here. You got to get out of all this portfolio in front of a recession for sure, which is non-farm payrolls go negative for more than 2 or 3 months in a row on a revised basis. Get out of this portfolio for sure. However, you're going to have a tougher decision to make when there's a valuation contraction just because this whole stock market is overvalued. You can see if the stock market goes down 10%, this portfolio will go down on a portfolio-weighted basis 15%. So the issue here is, do you want to ignore value, and how long do you want to ignore value, and what is your strategy to get out of this portfolio in front of a recession for sure, and then what is your strategy about a correction?
Right, exactly. And then one other thing I wanted to note, there are a couple stocks where they're all in the same industry. We do see 3 or 4 different biotech names on here. We can see PIRS, and then right next to it we have LGND, both pharmaceutical companies. I think if you're going to have 4 or 5 pharmaceutical companies, at least from my personal perspective, it might be better to just play with an ETF such as XBI, which is an equal weighted fund. You're going to get plenty of exposure to a bunch of different companies. Or if you want to go more targeted, you got CNCR, just focuses on immunotherapy companies. I think that might be a better strategy than just trying to guess on 4 or 5 different biotech stocks. As we know, those can always be super volatile. Anything else you wanted to note about the sector or industry components? I know you didn't really care for the industry ranks for some of the names here.
I didn't care for the industry ranks, and I want to be honest, I'm not a big gold, silver gun guy. Gold stocks, silver stocks, my personal opinion, you should be swing trading those because they're moving in a range and getting in and out of them. I don't like them on a portfolio-weighted basis. The whole idea of us blowing into some inflation story and all this stuff, I haven't seen it. I don't like it. The gun stock thing also, I think, is a completely overdone thing.
Yeah, and they've certainly struggled as of late. I know RGR's been down a ton. Thanks to the new administration. There's not as many worries about new rules there. And then just another comment about the gold and silver. Those also have very poor industry ranks right now. So I do think the material space might be a little weak, at least in those 2 areas in the near term. You did have another slide here we wanted to note, and that is actually the total size of the portfolio here. And maybe you can explain what your goal was by showing all these companies and ETFs on here on one slide. What were you trying to get across?
Yeah, my point here is exactly this. If I am trying to have a conversation, even between, this is a couple that has this portfolio, and have something to say month on month about this many stocks. This took me an hour or 2 just to put these many comments together.
Yeah.
Now I got to do that every month.
Yeah.
And I got to do it with you. And so you can see that this is one of the problems. The management of the portfolio and the processing of the information is extremely high and probably not a lot of value going into that process to begin with. So you got to throw some people off the island here. There's got to be a discussion of how to basically have the size of this portfolio. You brought up ETFs, but I would also just add, decide when you have 2 stocks here that are similar, get rid of the one you like least.
Right. Especially if they're in the same sector.
In the same sector.
Yeah, exactly. And then
throw them off the island. And get an account together and throw them off the island.
Right. You got to think of a survivor mentality for the portfolio. Just the best are going to stick around.
Exactly.
One other thing I wanted to note, and that's some of the ETFs that were in the portfolio. I am a ETF strategist, as you know, John. And there's a couple interesting items I wanted to take into account because they do have a lot of interesting ETFs in there. One, the BOTS fund. There's also a robo ETF out there. It actually has more in assets and it's a bit more diversified, so that could be a decent option. And that's actually also in the ETF Investor Service right now, so I do prefer that one. FAN, if you do like the wind power space, that's a good choice, but there's some broader options out there too if you want to go beyond just the wind power area. You want more of a broad basket approach. iPay, that's a good mobile payment strategy, but you're going to get that same exposure in a fund like FINX or FINQ, and those offer up more exposure to the broader fintech world. So I think it could be a bit more diversified play. And then, John, this SMIN is a small cap India fund, but that's going to be very volatile. And as you note, with if we do see a pullback, it's going to be especially in trouble. But two other India funds to look at are INXX, and that's the India infrastructure area, and then INCO, which is a consumer. I kind of like both those areas. I think they could be higher growth stories, and you're going to get more targeted exposure there, and I do prefer both those segments.
Yeah, let me recap some of the things so we can get the broad sense for this strategy here. Robots, right? Robotics, wind, iPay, which is e-commerce, financial, and then small cap India. So this is a portfolio that loves the stories, the big growth stories.
Exactly.
That's what we're talking about, people. When we talked earlier, this is what we're talking about.
Right. Exactly. Well, I think that's about all the time we have for today. Definitely tune in next week for another portfolio update. But until then, for John, I'm Eric. Have a good one.
Before we get to the top stock picks, here are a few things you can expect to see coming up. Make sure to check out the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks hand-picked for immediate profit potential. Plus, keep an eye out for a brand new special report by Brian Bolin, who'll delve into cybersecurity. That'll be posted on the Zacks Ultimate homepage in the coming weeks. And don't forget, the next Zacks Ultimate Strategy session will be in early September, so start thinking of submissions for Righty's Mailbag and the Portfolio Makeover segments.
Hey everyone, Eric Dutram here with your top stock pick for the month of August. One company I'm looking at right now is Owens Corning, ticker symbol OC. This is a Zacks ranked #1 strong buy, and I like it partially thanks to its recent beat on earnings, but also thanks to some recent earnings estimates as well. We can see that in the chart right here, where the company has seen earnings estimates rise about 7.8% for the full year and nearly 10% for the following year. We also see great agreement among analysts, as no analysts have declined their estimates for the full year and none for the second year as well. Now, another key aspect to note about OC is the company's valuation. It does receive an A grade on the VGM score, and that's partially due to its better PE than the industry, better earnings yield than the industry, and its better PEG as well. Now, how has OC been able to do this and become a great value stock? Well, part of the reason is they've really been doing a great job of improving their margins over the last 5 years. As we can see right here, margins have gone from about 7% up to 13%, so a really great trend for the company on this front. Now, another key aspect to note when it comes to margins is that the company's been moving slightly away from its insulation business and more towards roofing and composites. This is key because roofing has a much higher margin, especially when compared to insulation. Composites is also becoming a stronger area of the business, and that's important when we look at the global picture as well. OC is really diversified across the globe for this area, and it's going to be in a number of key market segments that could be experiencing nice long-term growth in the future as well. Well, that's all the time we have for right now. Make sure to tune in next month for 2 more great top stock picks.
Hi, I'm John Blank, Chief Equity Strategist of Zacks. I'm going to talk, my top stock pick for August here is Hitachi. Hitachi, you've probably heard this company. It's a Japanese company. It's a Japanese company that supplies capital goods, electronic mostly, mainly sophisticated info tech for companies, not for consumers. This is the key thing I want you to understand is I'm interested in CapEx in Asia. Capital expenditure is what that means, and I want it coming from Japan to mainland China. I'm looking for that vehicle. I'm looking for the Zacks rank that says the analysts are picking it up, and that is Hitachi, H-T-H-I-Y. Now, let's take a look at Hitachi's chart. I want to show you one very key point. The one thing you need to understand about the global economy now versus 3 years ago. You can see that the 3 previous slides down in earnings was 2014, 2015, and 2016. The Japanese earnings for this company stunk, and they kept getting revised down all year. So the story was not getting better. That was the problem with the earnings recession in the United States, is it was pumping in the problems in the global economy. That's the total opposite of 2017. Earnings estimates for each are going up. And Hitachi, by the way, is in the last 3 earnings estimates have gone up by a total of 150%. It's incredible. So Hitachi's really turned the corner. They're a stock that's $68 a share. You can see the highs were $80, $85 2 years ago. I'm looking at 90 as my price target on this stock. That means we've got a good 30% move from here. I think you can get there in about a year. So I would hold this stock on a momentum trade. You're going to see some fluctuations up and down as people move in and out of the stock. But by and large, you can get a 20, 30% gain out of this stock pretty comfortably. And by the way, the price-earnings ratio of this stock is 11. 11, the price-earnings ratio in the S&P 500 is 17.7. So you're not buying a big downswing that can happen from the valuations. And that's it for me, Hitachi.
Well, that's another Zacks Ultimate Strategy session. We hope you found it interesting. And remember, if you have any feedback, please don't hesitate to send it to mailbag@zacks.com. Also, if you have any questions about the Zacks Ultimate service itself, don't forget you can always contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers should use 312-265-9309. Until next time, thanks for watching, and as always, we look forward to sharing success with you for many years to come.